Good morning. Welcome to the December 12th, 2019 Fiscal Management Committee meeting. I'm Jeanette Dixon, the chair of the Fiscal Management Committee and a board member at large. And we will have the other board members introduce themselves and then go around the table. Okay, Ms. O'Neill.
Pat O'Neill, member of the board, District 3.
Dr.
Oh,
Daka.
go this way now.
Yeah, we'll do the board first. Yeah.
Judy Daka, District 1.
Okay. All right, we'll go around.
Yeah, hi, I'm Dan Morell, the Director of Fiscal and Audit Management for the Board of Education.
Becky Gibson, recorder for the meeting.
Good morning, Nikki Diamond, Chief Financial Officer, Montgomery County Public Schools.
Good morning, Susan Lau, Senior Investment Officer, Division of Investments.
Good morning, Marissa Grant, Chief Investment Officer, Montgomery County Public Schools.
Good morning, Andy Zuckerman, Chief Operating Officer for MCPS.
Great. So thank you, everyone. We will just have a quick change in the agenda. We will do actually item 5.1 before 4.1 because our actuaries have an additional meeting outside of the building. Is that okay with you, ladies? Okay. All right. We have the informational summary. Do we have any changes?
Nope.
No changes? Okay. All right. Then we are on to item 3.1, the year-end pension report.
Good morning, board members. As you know, Montgomery County Public Schools manages our pension fund. Our pension fund includes the fund for all of our employees who have a supplemental pension benefit, as well as for those employees not covered by the state teachers retirement fund. About 89% of our salaries sit on the core pension being on the state fund, but the remaining are on the local pension fund. And today we'll be providing you an update on the status of that pension fund. Marissa and Susan will be providing you that update. Just as a reminder, if you think about our pension in terms of how we manage it, there are two aspects to it. There is the investment side and managing of the investment, and that is done by Ms. Grant and Ms. Lau. And then there's the actual implementation, the day-to-day. That's the process of supporting our employees as they make decisions about retirement, as they work with the state, and ensuring that the payments are made and any changes to payments are made. And so that's done through Mr. Talor's office and is a different part of the process. Today we'll be talking about the pension fund. And so I'll turn it over to Ms. Grant and Ms. Lau to provide us an update.
So I'm going to kick it off. I'm Susan Lau, and I'm here this morning along with Ms. Grant to review the assets of the defined benefit plan and to provide you with a summary of the OPEB trust. Both trusts contains assets that provide pension and healthcare benefits for MCPS and retirees. So as you know, the pension assets are overseen internally and guided by the Board of Investment Trustees. The objectives of the pension trust are twofold. One, pay benefits when benefits are due, and two, achieve the 7% actuarial rate of return, which you'll hear more about later from the actuaries. With those targets in mind, the Board of Investment Trustees, in conjunction with its external advisors, construct a portfolio that balances potential return with expected risks. Now, I want to quickly review the key components of this pension, the assets and the liabilities. Here on this slide, you'll see a scale. On the left-hand side in green are the building blocks of the assets, which include the annual contribution from MCPS, the contributions from employees, and the returns generated by investing these assets. On the right-hand side of the scale, you'll see the primary components that drive our liabilities, including the negotiated payout rates, the number of employees, and the life expectancy of our employees. Assets and liabilities can fluctuate from year to year, but the size of these building blocks are on the scale are fairly representative of their importance over the life of this plan. Later on, I will be giving you insights into the portion of the assets that the Board of Investment Trustees have the greatest influence over, the yellow block on this scale, the investment returns. So here are the numbers behind some of those building blocks. In fiscal year 19, the largest contributions to the assets came from the school's contribution of $87 million. followed by our investments at 78 million. And lastly, our employees contributed 27 million. When you take into account the 101 million of benefits paid to MCPS retirees, the pension ended the fiscal 19 year with a balance of a little over 1.8 billion. Much like last fiscal year, the combined contributions of MCPS and its employees slightly exceed the pension payments of the year, and this allows any investment returns to be deployed towards reducing the gap between the present value of our liabilities and our assets. And it also helps improve our funding ratio.
Susan, let's hold there just for a minute, because I want to make sure that the board and the public understand what we're sharing here. This is a really critical part of the process. So if you recall a moment ago, I explained there were two different parts to managing the pension. One is managing the returns, the investments, and that's what we're here to share information for you on today. The other part is managing the payouts, managing people going through the process of retiring. And so what you see here is the money that's inflowing and outflowing. So the inflowing money is the money that each of us as employees contribute to the pension. So we all contribute. If we're part of the state pension or our core is on the local, we contribute 7% of our salaries. And then we contribute 0.5% of our salaries to the supplemental. So that 27 million you see there, that's the employee contributions, that's the required contribution. Every year, and you're going to hear an update from our actuaries today, every year MCPS, as part of our budget, has to also determine how much money we need to set aside as part of the MCPS operating budget to support the pension and ensure that we are fiscally sound. And so you'll hear an update today from the actuaries around their projection and their recommendation for next year. But in this past year, MCPS contributed $87 million of our operating dollars to support the local pension. We also must contribute to the state pension. What years back was classified or was called the shift, the pension shift. We now contribute each year to the state the normal cost of the pension for all those employees on the state pension. So both of those numbers are part of our operating budget, and you will hear this next week when the superintendent shares his budget. So we have two inflows. Those are the employees and MCPS. And then the other inflow is the investment return. So that's the key work that Ms. Lau and Ms. Grant are sharing with you today. We make decisions as an investment board about how to invest those funds and how we can get our best return, because we know that on any given year we have a required payout. That's the $101 million. The part that Ms. Lau was just pointing to is a really important part, which has to do with, are we cash flow, I guess the best way to describe it is positive, in terms of how much money is going in and going out. When a pension reaches a point where it is not cash flow positive, so if less money is coming in than needs to go out, so you can see there 87 and 27 coming in, 101 going out. We have enough money coming in to pay all of our pension payouts. We have more money coming in, meaning we have enough to cover that. If we didn't have enough to cover that, then we would have to actually dig into the investment, and that impacts our ability to invest. And so that's a very important part of the process to understand whether we need to have some more funds more liquid and available to us because we need them for payouts. Right now we remain cash flow positive, which allows us to be able to make different types of decisions with those investments, and in turn we hope make better investments. So I'll turn it back over to
So the 78 million, that is how much we earned from the investments, correct?
Yes. Yes.
Okay, good job.
So going deeper into the investment component, and this is kind of how the sausage is made. So we're going to dive a little bit deeper into the yellow block on that scale slide that we had just seen, which is to focus on the investment returns and how these returns are produced. So as I mentioned earlier, one of the primary objectives of the Board of Investment Trustees is to construct a portfolio with exposure to multiple investment strategies. And this is not all inclusive of all the investment strategies out there, but these are the core ones that we're focused on. And in investing in multiple investment strategies, we believe that in aggregate it will achieve the 7% rate of return. Now, this is a slide you've seen before and remains relatively unchanged. It illustrates the investment strategies currently in our portfolio. The portfolio still remains tilted more towards the return-seeking spectrum that I will talk about later on. And if we move from the left to the right, the left-hand sides are those strategies that should produce higher returns for the portfolio over time, and the ones on the right hand side are those that will generally provide protection in weaker economic environments. Part of our day-to-day work includes maintaining the appropriate balance of these investments, and in every investment decisions we recommend, we ask ourselves these fundamental questions. How does the change improve the likelihood of achieving our objectives? What role does this decision serve in the above framework that you see here? And how do we expect this change to impact our portfolio over the intermediate and long term? So moving on to the next slide, this is where we stand today against our targets. The chart here depicts what our long-term targets are for these strategies versus where we are today. And I know the font's a little small in terms of the exact percentages, but the blue bar is essentially our targets, and the green bars are where we stand at the end of fiscal 19.
So Ms. Lau, let's just clarify. This is the percent of the fund we're investing. This is not return.
No, these are
So
not
we have
returns.
targets based on where and how much we believe we should be reducing risk and how much we should be seeking return. And so ultimately, we want to move ourselves towards what you see as the blue bars. It's not as easy when you're investing almost $1.8 billion to move large amounts of money. We have to make decisions, take a long time. Once we make the decisions, they have to go through an entire process. So we're moving towards these targets because we believe these targets are the best balance given the market right now.
And as you can see here, 65% of our portfolio is actually more towards the return-seeking strategies, and those are the three leftmost bar that you see there. And the balance of it with risk-reducing strategies are the last four bars in this chart. And as Nikki had alluded to, the portfolio is constantly in flux. So why are we not at some of these targets? These movements include our ability to find the right investments and to meet the objectives we laid out, or terminate the ones that we feel are not consistent with our objectives anymore. It also includes market fluctuations that can make these targets harder or easier to obtain. And then there are the investments that are, as Nikki had mentioned, easy to get in and out of, but others that actually require multi-year work to achieve. So the work involves in identifying those investments, monitoring them, coordinating all the different moving parts and the expected impact it has on the portfolio. And so let's move to the performance component.
And one thing I'd like to add on one of the points that Ms. Lau described earlier about us being cash flow positive, or perhaps it was Ms. Diamond, what that allows us to do is have more of the portfolio as we currently have on that left side of the chart, because those are the types of exposures that will allow us to have. We expect to have higher returns over time, but they're illiquid. Many of them are illiquid, and so you're committing to managers for very long periods of time, and in order to do that, you need to not have to worry as much about liquidating part of the portfolio to pay current year benefits. So our ability to have our contributions from the schools and from employees exceed what we're paying out is critical to us having the asset allocation that you see in front of you.
So let's now review the returns for fiscal 19 of this portfolio. As you see here, we lag the policy benchmark, which is the portfolio that we would target, going back to the blue bars and the green bars in the previous slide. That would be our policy benchmark. And we actually lagged the policy benchmark, but performed ahead of our allocation benchmark. The primary contribution to the underperformance relative to the policy, as Ms. Grant had just mentioned, is that gap between the portfolio's target and the actual weight in the private equity, a liquid component of those assets, and as well as an overweight in non-U.S. developed markets and global equities. So I want to emphasize here, while it's prudent to review the short-term performance, it is important to keep in mind that we manage our investments based on a long-term horizon. From that perspective, over a 10-year time frame, we had actually exceeded our return objectives. And on that key point, we will continue our work to narrow the gaps between our current and target allocations and continue to refine the investment strategies in the portfolio accordingly, which leads me to our priorities in the next 12 months.
Ms. Grant and Ms. Lau, can you explain a little bit about, I think it's important because we have a lot of conversations about that the board and the public understands that sometimes we have to actually pull money and hold the money so we can get it in the investment we want, which means waiting for a longer term return. So in a short term, it might look like we didn't get a lot of return. However, we're actually in the process of seeking the larger and the higher return, those on the left-hand side. So can you explain a little bit about how that process works? And some of the timelines, I think, as examples will really help the board understand, how long it might take us to get money into the places we need to get it into.
I can take it. Okay. So what Ms. Dime was actually talking about is a lot of the investments that we're trying to accomplish is the private equity component. Now, that asset class in general, as a lot of the market assumptions would dictate, is supposed to generate higher returns. But part of that higher returns is tied to a liquidity premium to it. And what happens is these funds are not open all the time. It's not like investing in a mutual fund or index fund where you're like, oh, I want to put 10 million in, and the next day, boom, you have 10 million fully invested. A lot of times, these investment strategies are open periodically, perhaps every 3 years, sometimes every 2 years, depending on the fundraising of that specific investment. And so oftentimes what happens is if we catch the window, if the window is already closed, we would have to wait a period of time to either identify another investment that we can be potentially investing in, or perhaps wait for that investment manager to open the next fund where we can, go in, do our due diligence, make sure it still fits our overall investment framework, and then follow through with the paperwork and the investment cycle involved. So that's part of the component that is difficult a lot of times in managing. And in the meantime, not having the ability to go into these certain investments, we might actually be over-invested in some of the areas that we've seen here, perhaps in the global equities bar in the previous slide, where it seems like, oh, wow, we're really beyond our targets. Well, the reason why we're really beyond our targets is we can't just hold it in cash. We need to actually be fully invested the bulk of the time. And so we're over-invested until we get into these more illiquid assets in hopes of bringing down that, bring down that overweight to that target. So now we're going to just quickly touch upon our priorities for the next 12 months. So as part of the work that I've described thus far, we look to make sure we have the right partners, vendors, and resources to sustain this work. This priority was informed by the consultant review of our investment operations performed last year. As the portfolio has grown and the components have become more complex, we are carefully scrutinizing our current structure and partners to assess whether we have the adequate resources moving forward. In addition, we look to continue to review and assess the portfolio's long-term strategic allocation in light of the market environments and evolving long-term trends. As I've described before, again, the portfolio is constantly in flux. The markets are constantly in flux. The economic environment that we're operating under is also constantly in flux. So the targets that you see may also change from time to time, depending on the backdrop that we're operating under. And that's the work that we have to continue on a daily basis. So now I'm going to turn it over to Ms. Grant, who will review the assets of the CHRBT.
Good morning. As the board is aware, MCPS retirees have a health benefit that is provided by the schools, and that benefit is described as a other post-employment benefit, or OPEB. And those liabilities, that liability to the school, the assets associated with it is managed by a trust overseen by the county, and that's called the Consolidated Retiree Health Benefit Trust, CRHBT. So the largest of there are 11 agencies currently throughout the county that participate in the CRHBT. The largest of those is the Montgomery County government. They represent about 48% of the assets in the trust, and the next largest is the schools. We're about 42% of the assets as of June 30th. So,
Now, is that where the county executive borrowed some funds from that?
He did not, I'm
Bar-
sorry,
I wouldn't describe it as a borrowing. It's so the contributions that the government makes to the trust on behalf of the various participating agencies, the timing of that can sometimes be a little tricky because there are many other considerations that the government has to make with respect to ensuring that the assets, the income that they expect to receive is going to come in. So from time to time, they may hold back their contribution until they are certain that they're going to have the revenues that they anticipate, and then they'll make the contribution. So there can be a timing differential. It's possible that they intend to contribute a certain amount, but then they're not able to contribute that full amount, again, based on their assessment of where their revenues are or where expenses have been. But it's not a borrowing. I wouldn't describe it as a borrowing.
So I'll add a little more to that, and you will see this in the actuarial report in a few minutes. So every year when just like the actuaries make a recommendation to you as a Board of Education as to how much you should put from your operating budget into the pension fund to keep the pension fund healthy and stable and funded to meet the future requirements of pension payments. They also make a recommendation to the county government for our portion of the OPEB fund, as well as they happen to use the same actuary as we use. They make a recommendation for the other portions of the county government how much to invest. Just like you wouldn't have to invest what is recommended by the actuaries, the county government did not follow the recommendation and did not put the full investment in the past few years. Last year, there was a significantly larger amount that was not put in, and you will see that there was some news around that, but you will also see that in the actuarial report later this morning, noting that. So it's been going on for numerous years where there's a portion of it that is not put in, but it was because there was more not put in. And that's part of the reason why, not completely, but part of the reason why you can see that our OPEB liability and the funding of that, and Ms. Grant will talk a little bit about that, is at 29% compared to our pension fund, which later on you'll hear is funded closer to 83.5%.
Mm-hmm. Okay.
So turning to the next page, this shows the 11 agencies that are currently participating in the CRHBT, as well as their respective inflows and outflows associated with those agencies. The investment portfolio has grown. It stands at almost $1.1 billion as of the end of the fiscal year, June 30th, 2019. The total return for the investment portfolio was 8.3% versus a benchmark return, their target return of 8.2%. So a very healthy year, and exceeded the 7.5% return for the CRHBT trust. The trust longer term return was 5.8% for the preceding 5 years versus the benchmark return of 5.5%. So slightly under, but still in excess of the target benchmark. Over the course of the year, one notable development that I would share is that the Board of Trustees that oversees the investment portfolio, they decided to delegate investment authority to the staff to help streamline the investment decision-making process. That required a legislation passed by the County Council, which was successfully done over the course of this past fiscal year. Are there any questions that the board has for Ms. Diamond, Ms. Lau, or myself?
Questions? Pat? No questions? So we're in good shape here.
We are in good shape.
That's good.
We are in good shape.
All right.
Okay, thank you.
Okay. We are now ready for 5.1, the MCPS self-insurance program.
I think we are doing the actuarial valuation before we do the
I'm sorry.
self-insurance.
Do I have a
Is that
mixed
correct?
up? Hold on just a sec. Yeah.
Okay, great.
Okay, yes, it's correct here. It's incorrect on the other agenda. I'm looking at 2 agendas. Yeah, the actuary valuation. Want to introduce yourselves? Thank you.
Good morning. My name is Lance Weiss. I'm a senior consultant with Gabriel Roeder Smith & Company. I'm joined by Amy Williams, also a senior consultant with Gabriel Roeder Smith & Company, and we're here to provide the results of the July 1, 2019 actuarial valuation of both the pension and the retiree health care program.
Thank you.
So, Amy, I'm going to turn it over to you to start.
We are beginning on slide 2 of our presentation. Before we started the actuarial valuations for this year, we did a review of the assumptions used in those actuarial valuations. We did an experience study covering the period July 1st, 2014 to July 1st, 2018. And typically, a review of assumptions or an experience study would be conducted every 3 to 5 years. So we just completed one. The purposes of an experience study are to determine the continued appropriateness of the current actuarial assumptions. And how we do that is that we compare the actual experience during the experience study period against what we would have expected under those actuarial assumptions. And then we either validate the assumptions that we have been using, or we recommend changes to those actuarial assumptions in order to use assumptions going forward that represent our best expectation of future experience. Next slide. Slide 3, we have a grid on this page and the next page with a summary of the changes in assumptions. So the assumption itself is listed on the left-hand side of the page. Then the column that says current assumption is the assumption that we had been using for each of those components. And then the column at the end are the assumptions that were adopted for use in the actuarial evaluations as of July 1st, 2019.
Amy, let me just take a minute and explain to the board that one of the reasons the assumptions are so important is those assumptions drive the recommendation that the actuaries bring back to us, that we bring to you, about how much we need to invest from our operating budget into the pension to ensure that we can remain financially sound to be able to pay our pensions into the future. We also are managing expectations around how we manage our budget. So if the only thing we needed to worry about were the budget for our pension, then we would be making a little bit different decisions, because one of the things we have to be very concerned about is making moves that shift our budget up and down dramatically from one year to the next. So we don't want to make a shift up and then the next year make a shift down, because it impacts your ask to the county executive, to the county council. And overall, those shifts impact us in terms of maintenance of effort and other things. And so we spend time working with the actuaries when they make an initial recommendation, which stands alone as, if nothing else were at stake, as what we might choose. But we combine it with all the other things happening with the budget and look to smooth decisions over time. So you'll notice in some cases here that there is a GRS recommendation and then a little different MCPS recommendation as to what to move forward. And that is because we recognize that the Board of Education wants to have a smoothing effect in terms of how you create a budget, and having a large increase one year followed by a decrease the next year followed by an increase the next year impacts our ability to get funded. And so rather than making big jumps up and then down and up and then down, what we look for is smoothing in those changes. And so, for example, I'll look at the price inflation. There were a variety of reasons why we made a decision and are moving forward a recommendation to you that is not the 2.25, but rather the 2.5. Part of it has to do with the smoothing, and part of it has to do with other factors that we recognize that are occurring in terms of our overall budget. So I wanted to explain that we didn't just look at the numbers and decide not to do them, but we took a considerable amount of time. Ms. Lau, Ms. Grant, our team sit and work with the actuaries when they bring the initial assumptions and recommendations before we bring a recommendation to you.
And I'll also just add that when we make a recommendation for an assumption, it doesn't mean that that's the only assumption that we think is reasonable. So we were very comfortable with the assumptions that were adopted and thought that that set was reasonable as well.
Okay.
So I'll just highlight some of these assumption changes because you'll see the impact on the actuarial valuation results later in the presentation. So the price inflation assumption is an assumption that drives some of the other economic assumptions. So price inflation affects the assumption used to estimate the cost of living increases that retirees will get on their benefits in the upcoming years. So if you compare the columns with the current and the MCPS recommended, you'll see that those rates have decreased, meaning that we're expecting that retiree benefits will increase at a lower rate than we had previously been assuming because those increases are tied to changes in the consumer price index or inflation. The investment return assumption, there was no change, stayed at 7%. Then salary increases, there were some changes in the salary increases that are assumed in the actuarial valuation. Generally, there was an overall increase, but those assumed increases vary by age in service, and then they're different for the staff versus the teachers. Next slide. Then we have what we call our demographic assumptions or people or behavioral assumptions. So the first is mortality. We make an assumption on life expectancies and how long participants are expected to receive benefits. So we recommended a change to the mortality table to reflect that. And despite the naming convention of these mortality tables, the recommendation that we had for the mortality rates is actually the most recent mortality table that has been released, and it's specific to public sector mortality experience. And this and the retiree cost of living adjustment assumption changes were the main drivers in affecting the actuarial valuation results. We also recommended some changes to the turnover or termination rates, the disability rates, the retirement rates. For retirement, we saw that employees were actually working longer than the actuarial assumptions were reflecting, so we made a change there that we're now assuming 100% will retire at age 80 instead of age 70. However, we recognize that there are some employees that work even later than that. And then we also made some changes to the OPEB assumptions in terms of participation, so how many retirees will elect the coverage when they're eligible at retirement, and then the assumptions related to how many will cover a spouse or another family member when they elect that coverage. And now we're going to move on to the actuarial valuation results unless anyone had a question on the experience study assumption changes.
Keep going.
All right, so we're going to turn to the pension actuarial valuation results first, and I'll do that, and then Amy will follow with the other post-employment benefits or retiring medical benefit actuarial valuation second. So in terms of the pension funding actuarial valuation, we want to go to, let's see here, let's go to slide 7. So as Amy's already mentioned, we made some changes to the actuarial assumptions as a result of the full experience analysis that we did, looking at the actual experience of the plan membership during the period July 1, 2014 through July 1, 2018. And as Amy's already mentioned, we made these changes. Basically, we had a decrease of the price inflation assumption, which resulted in changes to other assumptions that, the price inflation is a component of. So it's the retiree COLA, the cost of living adjustment, payroll growth, salary increases for cost of living. So all of those changed as a result of the decrease to our price inflation assumption. And then Amy's already gone through the changes to the demographic assumptions. And as she mentioned, that's the people assumption. So it's the rate at which people die, retire, become disabled, quit, etc. So let's turn to the actual results on page 8, slide 8. So this is what we've got here is kind of a comparison of the results from last year's valuation as compared to this year's valuation. And one thing I should mention is that, before we even go through this, so the purposes of the July 1, 2019 actuarial valuation, which we just completed and are presented here, the primary purposes are to measure the funding progress of the plan. So what's the funded percentage as of July 1, 2019? And then we've also done some projections on that. And then also to determine the recommended annual contribution to the plan for the plan year commencing July 1, 2020 and ending June 30, 2021. So it's the upcoming fiscal year. And we do it in advance so that you have time to budget for those contributions. So I just wanted to mention, that when we talk about the 2019 valuation, we're budgeting we're coming up with a contribution for the next fiscal year. So looking at slide 8, we've got the results of the July 1, 2018 valuation as compared to this current val that we just completed, the July 1, 2019 val. And so obviously, a lot of the results are contingent on the membership, and your membership changed. The active members increased slightly from 23,286 to 23,464. You can see the inactives increased from 3,409 to 3,519. Those are the members who are not yet in pay status. The inactive members who have contribution balances only, that actually increased by 23% from 2,894 to 3,561. And then your retirees increased about just under 2%. From 13,768 to 14,019, and on a total basis, the population increased from by about just under 3% to about 44,563 now.
So these numbers are really important to your overall status when you think about the pension. We suspect that part of the reason why we have more members who are in what we call inactive contribution balance only. So you can be inactive because you're vested, but you're not yet eligible to receive payments. I worked for school system for 20 years. I leave and go work somewhere else. I can't retire, but I'm vested. And when I turn 62 or 65, depending on which pension system I'm in, I will be able to collect payments. That's an inactive member, not in pay status. An inactive member who has a contribution balance only is, I work for the school system. I don't get to vested status, but I've contributed and there's money there. So in the old system, so before 2011, once you worked 5 years, you were vested. The new law and the new guidelines is 10 years. And so more people will end up in this inactive member status, meaning I worked for, let's say, 7 years. I contributed 7.5% of my salary. It's still my contribution. Right. I have not yet acted on receiving that money back, which I'm allowed to receive back. I won't receive a benefit, but I do get my contribution back. And so those are the members, and correct me if I'm wrong, Lance, in this explanation. Those are the members, and part of the reason why we suspect we're seeing some increases there is we're right now, if you think about it, 2020, in the period of time where we're first seeing people who worked more than 5 years and aren't vested, because if you started in any time after 2011, if you work more than 5 years, you wouldn't be vested. If you started before 2011, if you worked 5 years, you'd be vested and you'd be in the not in pay status. That impacts the overall health and where we are in terms of funding of our overall system, because it impacts how many people are going to be eligible down the road to be paid.
Mm-hmm. Right. So, Nikki, I'm just curious about this. So, let's say you are vested, but you are not, of age to receive benefits. So, when you do become of age to receive benefits, does the person have to contact you, or do you contact them? And do we have people that don't collect, for want of a better word?
So that's a great question. Actually, Mr. Morella asked me a question about pension, how we check the status of pension. Are we sure that we're paying people who still are with us? And how do we monitor that? When I mentioned earlier that Ms. Grant manages the one side of the pension investment, and then we have a team, Shafina Yunus, who works with Mr. Talor, who will be here later this morning, he's actually in the room right now, to talk about a different topic. Shafina and her team oversee the operations of the pension. And so we have an entire process for contacting, as does the state, because remember, 80, depending on the year, but in the high 80% of our salaries actually sit with the state pension. And so the state does that work. In terms of the local pension, we do that work, ensuring that we are in touch with all of our employees. In fact, employees that leave us who are not vested, there is an entire process that we go through in terms of making sure that they're aware that they can have their pay contribution, or they can wait to get their contribution. Some people opt to wait. They receive a regular postcard, and I'm trying to remember the timing of the postcard.
3 months after they leave us, and then periodically we do a full meeting for individuals, just to remind them.
So I'm going to say that so it can be heard. So 3 months after someone leaves the school system, they receive a postcard, and then on a regular basis, we send reminders about for those that haven't requested their contribution. We do the same for people who are eligible for retirement, as does the state for pension payments.
Okay. So do we have people, though, that don't respond, when they become eligible?
That's a great question. We do have people, I'm not actually sure of the number and the percent, but when Mr. Tallur comes up here, we can talk about if he has that data, or if that's data that we can get for you.
Okay. Yeah, I'd be interested in knowing, just that. I think it's interesting.
It is interesting.
All right. So we're still on slide 8, and now we're going to talk about the liabilities of the plan. We've got the membership, the liabilities, and you'd already been presented previously the liabilities of the plan. But by way of comparison here between last year and this year, the liabilities have decreased. And they've decreased just under 3%, from about 2.3 million to about 2.2 million. Billion. It would be nice if it was only million, but it's billion, unfortunately. So just under 3%. And a big component of that is the change in actuarial assumptions. So what we're trying to tell you here is that and Amy mentioned, we periodically review the actuarial assumptions, generally speaking, every 3 to 5 years. We just did it, after 4 years. And we want to make sure that those assumptions are consistent with the actual patterns of the plan, the membership, the assets, et cetera, the asset investment experience. And so we have to, they're going to change as conditions change. So what we're saying here is that the assumptions that we've adopted now are suggesting that we need less assets, and so a lower liability. And we'll get into a reconciliation of that shortly. But basically, it's gone down about just under 3%.
I think the easiest way to explain this to the public is if you take all the active members you see listed there, and they, based on our assumptions, how long we assume people will live, what their final salaries will be, all those different assumptions, this is how much money we will owe them over time. Present value, basically,
Yes,
right?
yes.
How much money we will owe them over time to pay out their pension. The same goes for the inactive members and the current retirees. And so you can see when you change assumptions on how long the average person lives, what their final salary will be, that changes the liability. And so that liability, then we bring back to present value, and we look at how much they've contributed. This goes back to what Ms. Lau was speaking to you earlier about how much the employee contribution is, and that is how they figure out what we as a board should put in our budget to ensure that we are vested and can pay all of our employees when they retire what we owe them.
And the liability is going to change each and every year. We do an actuarial valuation each and every year, and as the membership changes, the liability is going to change, of course. And you can see the relative magnitude of the liability based on each of these components. So you've got 974 million due to active members. That's the present value of the liability. If we had 974 million, you'd be fully funded on your active members as of today, the members who are employed today. It's 50 million for that both inactive categories, and then it's $1.2 billion for retirees. So you can kind of get a sense of the magnitude of that total liability. In terms of the assets, and again, we call it actuarial value of assets. So the actuarial value is a smooth value, And instead of just using market value, which, could potentially have huge swings in market value, we smooth that out to try to minimize the fluctuations in your contribution. And so we use a smooth value. And so the smooth value of assets, which again we call actuarial value, went from $1.7 billion to $1.830 billion. So that's a nice gain there. And so the liability went down, your assets went up. That means your funded ratio goes up, and the unfunded liability goes down. So the unfunded liability is the difference, just pure dollar difference between liabilities and assets, and that dropped from $524 million to $360 million. And then the liability, which is the ratio of assets to liabilities, that increased from 76.7% to 83.5%. So I think we mentioned that, that was mentioned earlier, that you have 83.5% of assets necessary to pay all, the present value of all the liability today.
Right.
And that hopefully will change, in the future, and we've got some projections that show it actually does increase.
So that's a good thing.
That's a great thing. That's a very, very good thing.
Yeah, it's really
Yeah.
interesting to see, because I remember when Marissa talked about, changing the percentage last year, that we've done really well, so.
Yeah, 83.5%, we work on actuarial valuations for systems all around the country. And 83.5% is a very good result.
Right.
Yeah.
Good.
And we're always shooting for 100%, but 83.5, compared to the rest of the world, so to speak, you're doing very well. And honestly, we applaud you for that. So let's turn to page 9. So this is, so page 8 was the liabilities and kind of the underlying plan membership. 9 now is the actual dollar and contribution rate, dollar contributions and contribution rate. And so this is really, as I mentioned earlier, the July, we have 2 columns, July 1, 2018, that's the actuarial valuation we did last year. July 1, 2019, that's the valuation we're presenting here. And you can see on behalf of which fiscal year this is appropriate. So the 2018 val comes up with the contribution for fiscal year 2020, and the July 1, 2019 val that we're presenting now develops the contribution for fiscal year 2021. So I just want to make sure everybody understands which year, we're talking about. So if you go to, there's a line, your contribution basically is comprised of normal cost, which is the cost of benefits accruing during the year. What's the cost of everyone's benefit that they're actually accruing this past year? And then an amortization payment on the unfunded liability, sort of like a mortgage payment on the unfunded liability. So those are really the primary components. So you see the total annual required contribution, several lines down. Last year it was $97.7 million. This year we're recommending $87.1 million. And it came down again, and we'll talk some more about this, primarily because of the change in actuarial assumptions. The expected employee contributions, we talked about this earlier, that the total contribution minus the employee contributions represents the board contribution requirement. So last year, the board contribution was about $73 million, and this year we're recommending $61.7 million.
I think it's important to note here for the board, and this is really critical, when the actuaries do this for us, they are not accounting for any growth. So when we have to take this back, and when you get the budget presented to you, you won't see this exact number there. What you will see is this number plus the growth number, because if the school system is growing, which it is next year, and we're projecting some significant growth as we had this year, then we need to account for the additional staff we will be hiring and what we need to invest for those additional staff members. And so the number, the other number that they provide us is what we call a calculator, and this is the percentage of the overall salaries that we should invest. That's the number that we use when we go back and calculate, because the other thing that has not been accounted for here are the raises that you as a Board of Education will be given. So this is making an assumption about where everybody is right now, and if you as a board negotiate raises beyond that point, then we need to account for that. And so what we do in the budget that will be presented to you next week is we have made some assumptions in terms of how that will look without the significant raises, and with raises. And so that's a big piece of the overall budget. We use the information that our actuaries give us, and it all comes kind of full cycle. So you get to see the investment piece, you get to see the actuary piece, and then you get to see how that all ties into the budget as well.
Yeah, that's a really important fact, that these dollar amounts are basically representative amounts. The actual contribution rate is the next several rows down, where we say board contribution percent of payroll, the employer normal cost piece, and the amortization piece, and then the total. So the contribution that we're recommending is 4.63% of pay, as Nikki just indicated, for the appropriate period of time. That was the result of the July 1, 2018 val. July 1, 2019 valuation comes up with 3.81%. So it's the 3.81% that we're really, that's our recommendation. That's the contribution requirement as a percentage of pay.
And that is what we will take along with the policy you passed in terms of moving towards 90%. We take that multiplier and multiply it by the total salary base of what's in the budget, and that gives us the amount of money that we need to include in our overall budget for the local pension. And then we will add what the state provides us and has provided us in terms of how much we need to have in the budget for the state part of the pension.
So if we turn to page 10, here we've just got a breakout of that 3.81% contribution rate between the core and supplemental pieces of the benefit. And then we've got a couple bullets here too, where we've said, again, the estimated contribution when we apply that 3.81% to payroll, estimated payroll. Last year it was 73 million, and this year we're recommending, it's going to go down to approximately 61.7%, again, depending on payroll. But our thought as your actuary, our goal as your actuary is to make sure that you have money to pay benefits.
Right.
And so we always recommend that you try to shoot for 100% funded. And because the plan is less than 100% funded, as actuaries, we feel it's our fiscal responsibility to recommend that instead of reducing the contribution, you keep the contribution no less than what it was the prior year. And again, that's just from your actuary, as a result of our goal to make sure that the money is there. That may not be economically feasible, it may not be, affordable, but that's always going to be our recommendation. So if you turn to page 10, page 11, here we've got some reconciliations. This is the unfunded liability, and as we had already mentioned, it went from 524 million down to about 360 million, and you can see the components along the red line. There are, the increases or decreases. And so, for example, we expect, because of your funding policy, which is a fairly robust funding policy, we would have expected the unfunded liability to decrease by $26 million because we expected you're going to contribute a significantly larger amount than the amount necessary to just keep it level. Gain or loss in assets. So on actuarial value of assets, let's see, we estimated 5.3% on actuarial value of assets. And again, it's a smooth value of assets, so it's recognizing gains or losses over the last several years, over a consistent period of time. And so you've got some losses there that you're still recognizing. So on an actuarial value of assets basis, the return was 5.3%. So your unfunded goes up because your assets returned less than the expected investment return assumption. You had a gain due to salary increases that were lower than expected, a gain due to cost of living adjustments that were lower than expected, and a gain due to all of the other demographic assumptions such as mortality, retirement, turnover, disability, et cetera. And then the big gain here is due to the change in actuarial assumptions. So you can see that's reduced the unfunded liability by $154 million as a result of the change in actuarial assumptions that Amy already described. So if you turn to page 12, so this is in effect the same type of reconciliation, but instead of reconciling the unfunded liability, here we're reconciling the board contribution rate and the funded percentage. So you can see again, if you look down to the line, change in actuarial assumptions. That's really the big piece of the component that changed the board contribution rate as well as the funded ratio had the biggest impact. So for example, we start with the 4.63, which is the board contribution rate based on the July 1, 2018 valuation. And then you go down you can see the components. We expected that contribution rate to decrease because of your robust funding policy. It increased because you had some asset losses on actuarial value of assets. Let's see, salary increases, COLA increases, you can see the various components. But the big change there is the actuarial assumptions. The minus 0.85% reduced that contribution significantly. So overall, the contribution went from 4.63 to 3.81. And a similar situation with regard to the funded status. Funded status, which again is the ratio of assets to liabilities, went from 76.7% to 83.5%. And again, a big piece of that was the change in actuarial assumptions. So page 13 is our historical and projected funded position. And you can see here that we have additional information here on both the contribution rate as well as the funded status. And so the bars along the bottom are the contribution rate, and you can see it started at in 2016, which represented the 2018 contribution. It went from 4.68 to 4.63 as of last year, and 3.81, and you can see it's going to continue. That's our projection. Based on everything we know, based on the actuarial assumptions, based on the membership, today's membership, we project that it'll decrease to 3.22%. And the good news on the funded ratio is that we continue to see it increase from 83.56 to 90% for the valuation as of 2025. So all good news here.
I think the important thing for the board and the public to know is, one of the things we're very aware of is the long-term impact the pension can have when we aren't doing a good job in terms of keeping it funded. So you'll notice as you get closer and closer to 100%, the board contribution percentage goes down. Right. That is such a critical aspect if you think about the millions of dollars that you need when it goes up, and our need to support our students and our priorities. So being able to make good decisions in these years for the future to get us to that 90% has been pretty essential. The board last year, you all as a fiscal management committee moved forward a resolution to ensure that we were funding at an amount to get us to the 90%. And so that action has pushed us to move that dip you see in our funded ratio upwards. We first made some adjustments, as you noted earlier, Ms. Dixon, that Ms. Grant talked about, where we lowered our assumptions to 7.25% and then 7%. That brought on the dip, but at the same time, we ensured that we were investing at a rate to move us towards the 90%. So you can see us moving towards that 90%. The important part of moving towards 90% is not just being able to pay our pension liabilities over time. That certainly is important, but what the impact will have on the budget over time in terms of not pulling on the budget more and more, but rather pulling away from the budget more and more to make those funds available for other priorities and other things. So this is an important move that the board has made over the last 3 years to move us in this direction, and the board should really be commended. Yes. It is critical to think in the future and not just think about the here and now, and I think the board did an amazing job in making that decision last year because the long-term implications are going to be very beneficial for Montgomery County.
Just an observation, these decisions are critically important because the municipalities and businesses that did not protect their pension, the funding of their pensions or their OPEB, it's caused bankruptcies of some municipalities and some businesses that have gone kaput because of poor fiscal management.
The important part of that is every time we decide, and hopefully we don't do this unless we are in a situation where we have no other choice, not to invest as the actuaries suggest, you create a larger unfunded liability. When you create a larger unfunded liability, the next year the investment goes up and up. And so what you do is you create a cycle in the other direction. And so what the board has done to keep us fiscally sound with our pension is actually head us in the other direction. Making those short-term decisions do have long-term impacts on us over time.
Any further questions on the pension results?
No.
Okay, I'm going to turn it back to Amy, and she's going to go over the results for the retiree healthcare benefit.
Slide 15 has a summary of the changes from last valuations. As we already mentioned, there were changes in assumptions, well, some that affected the pension as well, and some different ones related to how many retirees elect coverage. In the valuation, we also reflect the most recent experience on claims, and we use that as a starting point for our actuarial valuation as well. And then we also look at how we expect premium trends to unfold in the future, and that's also incorporated as an assumption. Slide 16 has the OPEB actuarial valuation results. The setup is the same as the pension, so I'll just draw your attention to a couple of the items. There was a decrease in the liabilities from about 1.8 billion to 1.7 billion. We have a slide that explains the reasons for those changes. There was an increase in the assets. We use market value of assets for the OPEB valuation from about 456 million to 492 million. There was a decrease in the unfunded liability, meaning there was progress in paying that unfunded liability off. And then there was an increase in the funded ratio from 25.8% to 29.2%. Next slide, slide 17, we have information about the contribution requirement. So for the OPEB, similar to the pension, there's a funding policy to pay the cost of the benefits accruing in the upcoming year, normal cost, to make a payment towards the unfunded liability. That's the amortization payment. So taking into account all of that, the contribution requirement for fiscal year 2021 under the funding policy is about 143 million. Part of that is the benefits that are expected to be paid in the upcoming year net of the retiree premiums. So those expected benefit payments are estimated at about 74 million, which would leave an additional contribution above and beyond the expected benefit payments of about 69 million. Then as a percentage of pay, that contribution requirement has decreased from the last valuation to 8.21% of pay for fiscal year 2021. Next slide, slide 18, we have a similar reconciliation of the liability for the OPEB. Kind of works the same way as the pension. So we expected the liability would actually increase to 1.9 billion, but a combination of assumption changes and then favorable experience resulted in a liability measured as of July 1st, 2019 that was lower. So it's the approximately 1.7 billion that's at the bottom of this slide. Slide 19.
Amy, can we just wait one sec? I just want to highlight that part of the decrease, the $146 million here, is the healthcare related experience. We've had very positive experience in our healthcare fund, as you know, from our active fund over the last 3 years at this point. And so that actually has an overall decrease in terms of the impact on the OPEB obligation. The other thing just of important note here is you as a Board of Education do not make a decision. This goes back to your question earlier, Ms. Dixon. The county government invests in the OPEB fund. So as a board, you aren't making a decision based on the operating budget, how much money to put in the OPEB fund.
Slide 19, we have some historical information on the change in the funded ratio for the OPEB plan. And then also a comparison of the contribution requirements as calculated in the actuarial valuation versus the contributions that were actually made. So for the funded position, you can see that there's been an increase during the period on this slide. In 2016, the funded ratio was about 16.7%, and then measured as of July 1st, 2019, it's about 29.2%. So there has been an increase in that funded ratio over the past 4 years. For the contribution requirement, the blue is the contribution requirement calculated in the actuarial valuation. The green portion is the actual contribution that's been made. So you can see that for fiscal years 2018 and 2019, there has been a shortfall. So a contribution was made to pay the benefit payments, and then in some cases a small additional contribution in excess of that, but less than the amount that was calculated in the actuarial valuation as part of the policy. Slide 20, this just has some more of those same details, but I will draw your attention to the top bullet. So as we saw on the previous slide, the county has contributed less than the actuarially determined contribution from the valuation. So we recommend that the county resume contributing that amount that is calculated in the actuarial valuation in order to continue to pre-fund the OPEB plan and continue those increases in the funded ratio and decreases in the unfunded liability. And in addition, the policy used to fund the OPEB plan or fund the unfunded liability is 30-year open amortization of the unfunded liability. So that continues to make a dent in the unfunded liability, but that there's not a specific year in the future where that unfunded liability would be expected to be paid off. So under a 30-year closed policy, the unfunded liability would be expected to be paid off at the end of the 30 years. So I think that concludes the OPEB valuation results, and we're happy to answer any questions on the OPEB results or anything else related to pension.
I don't know whether, well, let me ask the question. Maybe I didn't understand it well, but the county executive has not put in the amount that we want for OPEB. It's not the recommended amount. Does that have anything to do with our bonding as the county? Relationship to AA or A, because that will in turn affect us with capital funds.
I am no expert. I can tell you that I've read some of the discussion that's gone on, as I'm sure you have, that some people are concerned that ultimately it can impact our bonded situation. I know that you might have read the Baltimore Sun yesterday, and local jurisdiction, not us, has a deficit in another fund, in their healthcare fund, and there's some questions going on as whether that could impact their bonded status. And so I know that that has been brought to discussion. There was some conversation. There were some insights from some experts, and we continue to just worry, because what happens when we don't fund it is certainly that it has an impact over time. Ultimately, having an OPEB fully funded is a good thing, because then you're not dealing with it through your operating budget. So right now we do, in addition to funding OPEB, the county government does that part, we are funding our retiree health care through our operating budget. Once OPEB is funded, and is in a different status, obviously, when it's funded, then the operating budget will not be needed in the same way to be funding the costs, we call them pay-go costs, of our retirees. So there are some benefits in the long haul to fund that and to take the recommendation from the actuaries. At the same time, when they're limited funds, important decisions need to be made by the county government, and they've made those decisions. As you can see from this slide, it wasn't just 1 year. Certainly we've had some history of this, and it goes back even further than this. And it takes much longer to get funded when you don't make the full contribution. I don't know if our actuaries want to make any comments.
No,
on how
I would agree that in working with other systems around the country and talking to the rating agencies around the country, they definitely take note of these unfunded liabilities, and that's part of the recommendation. So yeah, it does impact things.
As memory serves me, this last time when they went up to New York for the bond rating, for the bond, Montgomery County retained its AAA bond rating, but I believe there was a warning, or maybe warning is an official term, but a statement made in reference to the underfunding. They did retain the AAA bond rating, but it was noted that of the underfunding.
Okay, anything else?
Yeah, our retiree rates are slowing down. That's because they're younger and not ready to retire. Is that what it is?
I think what you're referring to is on slide, oops. Yep, slide 3. So I'll let Lance and Amy respond to that. You can see the number of retirees is increasing, active members. What is also increasing are inactive members, which are those that leave the system before they are vested. So I'm not sure retiree rates are slowing down. I'm not saying they aren't. We can get you some information on whether those actual rates of retirement have slowed or not from our Office of Human Resources. But there, you can see there are increases from the 23,286 to 23,464. I take that back. Those are our active members. Our retirees went from 13,768 to 14,019. My apologies.
Other questions?
No more questions.
Oh, thank you very, very much.
Thank you very much, and I want to thank Marissa and Susan. I don't think I thanked them before as well. Thank you. Very thorough job, thorough information, and I think we're doing a good job with the funds. Yeah, right. Good. Yeah. We'll have to tell our colleagues who are running for re-election to let the Retirees Association know. All right. Okay, we are now ready for 4.1. Yes? Okay. And this is the year-end financial report, Nikki, or?
This is both. It's going to be the
Right, and then
combination
the
of our
report of the
year-end financial
external
report
auditor.
and the
Right.
report of our external auditor. And so I will let Bill, our external auditor, and Rob, our director, to introduce themselves, and then we can get started.
Morning, Rob Riley, Director of
How are
Financial
you?
Services.
Good.
Good morning, Bill Arley, Principal at CLA.
Right, how are you?
Good.
Good.
So I'm going to give you an overview of our year-end financials and the process that behind creating them, and then I'm going to hand it off to Bill, and he's going to provide you with details of the audit. So as you know, every year we're mandated by state law to publish a complete set of financial statements in accordance with generally accepted accounting principles, or GAAP. For MCPS, that consists of about 75 schedules that cover a dozen different funds with about 50 pages of accompanying footnotes. When put together, it's called our Comprehensive Annual Financial Report, or CAFR. So this morning, I'm only going to go over about 70 of those 75 schedules. I'm only kidding. I'm just going to give you an overview. So what makes it fun is that...
We're ending at 12 o'clock.
So what makes it fun is that we have to get this all done within 90 days.
Yeah.
So when we close our books on June 30th, we have till September 30th to get it to MSDE. Some of my staff tell me some of my experienced staff tell me stories. In the old days, before you could send it electronically, they'd be driving down to Baltimore on September 30th to try to get that accomplished. This year, actually, there was a little twist to it too. So normally we would send our paper copies, hard copies, to MSDE. This year, and it is according to Comar, we did send them to the legislative chiefs as well as the legislative library at the state. So that was a different twist. So just the same amount that we print, we just were responsible for sending them ourselves. So truly it does take some long hours and extraordinary efforts by staff in those 90 days. But actually we could never get it done without having great processes in place during the year. These processes, or internal control activities, consist of monthly bank reconciliations, account reviews, procedure inspections, good initial budgeting, accurate financial monitoring, position control, safeguarding of assets, and limits on authority, just to mention a few. So with regards to limits on authority, this can be accomplished in a few different ways. Ms. Diamond relayed to you a few meetings back that it takes at least 3 different staff members to initiate, review, and finally approve a wire transfer. This is done through agreements with the banking institutions. We also have these limits built into our financial system by creating unique roles and workflow approvals. I just want to let you know, with our migration to the cloud for our ERP system, one of the many items that the transition team is tasked with is to ensure that these built-in controls are maintained, if not enhanced, when we go live on April 1st. Some of the controls we have in place are a fiscally minded superintendent, CFO, and staff that adhere to strong board fiscal policies and MCPS regulations. Also, we have an up-to-date financial manual, a robust internal audit department, and this Fiscal Management Committee actually serves as another internal control with respect to monitoring and helping to establish our control environment. In fact, all these things I've mentioned are part of our internal control environment, and that's what gives confidence to our auditors and prevents any surprises at year end. So this year, I'm happy to report no surprises. Our final general fund budgetary statement, which is page 40 of your CAFR, ended up with within a few $100,000 of what we had been reporting to the board in our monthly interim reports. For budgetary statements, I like to equate this to examining what's in your personal checkbook and determining if you have enough to pay all your bills and maybe have a little left over. Though I'm not sure if this analogy still works, because I asked one of my adult children if they balanced their checkbook, and they said, "What's a checkbook?"
Right.
So I think these days it might be a little different, but I guess I'm old school. So in addition to our budgetary statements, we also report 2 other levels of statements, namely governmental or GAAP and government-wide. Each level of statements reflects a progressively wider time horizon. For example, in our government-wide statements, we report all of our fixed assets and all of our long-term liabilities related to pension and OPEB, which you just heard about. Determining those liabilities are the work of our actuaries, which Amy and Lance kind of explained all the different data and assumption that goes into those calculations. Now, just a point on this, we distinguish between the valuations for funding and for what goes into the what goes into our CAFR. So in other words, per GASB 75, there's different assumptions that have to be taken into account of what we report in here as to what is used for the funding basis. One such, the main one is the interest rate. So the interest rate, we've moved from 7.5 to 7.25 to 7.1 in pension. In OPEB, it's still 7.5, but for this purposes, since we don't fully fund, and we've just been talking about that, how we don't on any given year fund that whole actuarially determined contribution, we have to use a blended rate, or it's called a single discount rate. And that rate, they take the 7.5 and you combine it with the bond rate, which is, it was 3.56 as of last year. So that blended rate is 5.87. And for that reason, our liabilities that were reported in here are actually higher than what you've seen in that previous report. So it's just another thing that differentiates the reporting from funding. So getting to our government-wide statements. In FY19, MCPS actually doubled our prior year net position on these government-wide statements, and those can be found on pages 33 to 35 of the CAFR. For a total budget rapidly approaching $3 billion, 161 million is what it's at. Might not seem like a lot, but the truth is, as was mentioned before, a lot of governments and school districts across the country have actually been reporting negative government-wide net positions over the last few years for the reasons I explained. Our near-term inflows and outflows that are reported on our GAAP statements also reflect an increase in fund balance by over 15 million to get us to $56 million. As if we didn't already have enough numbers and schedules on our CAFR, for better transparency, I actually added a fund balance schedule, which is on page 65 of the CAFR this year. And that details what our governmental fund balance is made up of. Speaking of fund balance, we currently don't have a formal fund balance reserve policies, but then again, neither do most of the other school districts in Maryland, whereas all of the counties in Maryland do have detailed fund balance reserve policies. The main reason for this is that county income, which consists mainly of property and income taxes, is subject to fluctuation on a year-to-year basis, whereas our income, which is mainly from county and state appropriations, once the budget is established in a given year is, for the most part, is predetermined. So what that means for us is we can kind of focus our efforts on budget management, on expenditures. And this focus enables us to run a tight ship through constant financial monitoring. Finally, circling back to our budgetary statement, we ended up with a $30.4 million increase, of which $25 million was used to balance our current FY20 budget, leaving $5.4 million in fund balance to start the year. And these budgetary figures mirror exactly what is in the financial report letter that was sent to the board last week. Bottom line is we have a strong balance sheet on all levels, largely due to having great internal controls in place. Any questions on my overview? If not, I'll pass it over to Bill, who's going to go over the audit and other required communications.
Rob stole most of the thunder. I'd be remiss if I didn't first thank Rob and Nikki and their staff. As Rob mentioned, it is a tremendous undertaking to prepare this entire document within 90 days and have it to the state. So there's sometimes in the month of September, as we're nearing the end, there are some late Saturday night, early Sunday morning conversations that are occurring between us and Rob and his staff to get things moving and make sure that we get everything to the state on time, which was done this year. Luckily, nobody has to drive anymore since we have the state actually accepts email systems. But so that is a big thank. It is a big undertaking, and they do a great job throughout the process. The process does take, we're on site in the spring for about a 2-week period. And then we're on and off during the summer, mainly testing single audit during the summer and following up on some things. And then we come back in August, September. We're here for about 4 to 5 weeks on site, off site. With the use of technology now, we're actually able to do a lot more remotely than actually sitting and taking up a conference room, which is good because space is getting tight for everybody, for all governments that we're working. So, but they do provide us with space, and we are up in their offices working. We do go out to other departments. We do go out to purchasing. We do some work with payroll, obviously, and various departments as we go through our audit process. So, so thank you to all of the MCPS employees that we worked with, but especially to Rob and Nikki and their team, who did a great job helping us out this year. I'm going to go through some of the highlights. Some of it is a little bit repetitive of what Rob said, but it's good information. The document is very long. I think it's total 200 and some, or 150 maybe, I think it is this year. There's a main component of it called the management discussion analysis, which is on page 17 to 30. That gives a very high-level review of last year compared to this year. So if you don't have time to read all 130 pages, I would highly recommend that you do look at pages 17 to 30 to kind of get an overview from a year-to-year comparison. On the government-wide financial position, Rob mentioned the total net position was $160.9 million this year. There was a unrestricted deficit in there, which is related to the long-term liabilities. And I think you guys have had about an hour conversation on those this morning between the investments and the actuary, so I don't think I need to talk about pension OPEB. I will just add my 2 cents to say that MCPS is one of the school districts in Maryland that we work with that is very knowledgeable of the funding and continues to make efforts, and is probably on the forefront for most of the school districts in Maryland when it comes to funding pension and OPEB. So you guys should really be proud of that. We have some school districts we work with which are putting no money in OPEB except for the pay-go basis each year. So their financial statements are that liability is rising exponentially year over year. So while we would agree with the actuary, it's always best policy to put in what their required contribution is. I'll give props to MCPS for at least making efforts to fund that liability annually. Moving forward, we'll talk about government, government fund financial statements. Total fund balance for all the governmental funds was $55.7 million. Unassigned was 0.3. The unassigned piece recommends or is related to the piece of that has not already been assigned, committed, or restricted. So the board is free to spend that how they would see likely. We did have a change in fund balance of $15.3 million, and a detail of fund balance can be found on page 65 of the CAFR. The general fund is the fund that most people like to focus on. That's the overall operating fund for you all. That had a fund balance of $55.3 million. Again, also total unassigned fund balance of 0.3, and the change for that one was 15.2 million. Most of the other funds, especially like your special revenue funds and all the other funds, are essentially a reimbursement fund, so fund balance tends to always equal what revenues and expenditures always equal. So there's not a lot of change there from year to year. So moving forward, your non-GAAP budgetary basis. Revenues were 25 million below budget. However, as Rob mentioned, you did an excellent job in budgetary expenditure monitoring, so you ended up with $52.6 million below budget of expenditures for an ending budgetary fund balance of $30.4 million, of which $20 million, I believe, is used for the 2020 budget. Then you had a change in budgetary fund balance of $16.2 million versus a budgetary decrease of 43.4. And all of this information can be found on page 40 of the CAFR. I'm also happy we have to report anytime that you overspend in one category per MSD and laws, which did not happen this year. So again, that's props to properly managing your budget and staying within the constraints that you set for yourselves.
I think the important part here is, you can kind of see the full cycle, right? We meet on a regular basis. You push us to make sure we're reporting to you. We meet our obligation by reporting to the county. I happened to be at a meeting yesterday with CFOs from actually all over the country, some in Maryland, and I was really surprised at the number that said to me they don't financially monitor on a monthly basis. And what ends up happening, mid-year through the year or in March of the year, where they don't have enough funds to meet their obligations or making last-minute changes. And so you as a board have really pushed us. We're following all the guidelines. And because of that, we're able to budget well, we're able to spend the money well, we're able to meet the needs of our students, and we do a good job with that. So really appreciate Bill's support in looking at what we're doing, giving us some advice, but what they've noted in the report and how we manage our budget, and you ask us questions and make us do what we need to do in terms of the reporting has really, I think, made a big difference for the school system's ability to budget from year to year.
Okay, so excuse me, moving on. So we audit two pieces. We audit the CAFR, and we also do a federal compliance audit, which is also known as the single audit, and includes the audit of the schedule of expenditure of federal awards and the data collection form. That happens after the audit. Actually, it's being finalized next week. It is due by December 31st, so we are on track to meet that deadline. We issue several reports, mainly being our independent auditors report. We also issue a report on internal controls, which is required by government auditing standards. We issue our report on each major federal program that we tested, and then we issue a letter to you all, which is called our governance letter, which was all issued, except for the report on the single audit, which is being issued, as I said, next week. Results of our, our audit procedures. We audit in accordance with generally accepted auditing standards. The purpose is to obtain reasonable, not absolute assurance about whether the financial statements are free from material misstatement. We assess accounting principles used. We look at any significant estimates used by management, evaluate those for appropriateness, and compare them to industry standards to determine any outliers that we would say, which we did not find any. And then we evaluate the overall financial presentation of the financial statements and provide any recommendations for changes to management. Next, we have our independent auditors report this year was issued an unmodified opinion again. It's also known as a clean opinion. It's the best opinion of assurance that we can provide to a client. It was dated, as I mentioned, September 27th, so it made it within the September 30th deadline. I'm also very happy to note that we had no material weakness or significant deficiency reported in our internal control report this year. We did have a management letter that was issued. It had one comment related to school cash balances and monitoring to make sure they do not go negative at any point. So, and that is being addressed, and that is monitored. Internal audit does a good job of monitoring the school fund accounts throughout the year. But anytime there is an issue, we do also report it as a management letter comment. And that will change moving forward. I'll talk about a new GASB that's going to have a little impact on that. The single audit report, as I mentioned, is being finalized next week. MCPS is considered a low-risk auditee because of the good controls you've had in place over the years, with no material weaknesses being noted. We tested 2 major programs this year, being English language acquisition and child nutrition cluster. I'm happy to report that our report being issued next week will show no findings related to either of those federal programs. Moving on, our required communication. As I mentioned, the scope and timing of the audit in September went as planned. Significant accounting policies are all in the CAFR in Note 1, and we concurred with those. Significant estimates, you do have, you've heard about OPEB and pension all morning, where there's a lot of assumptions related to those. Self-insurance also has an incurred but not reported piece that is considered an estimate, as well as depreciation over financial capital assets being in the financial statements. There was no uncorrected or corrected adjustments this year. We had no difficulties in performing our audit, no disagreements with management on the accounting practices used. There was no issues discussed prior to us being retained as the auditors. No issues related to what's considered a group audit. You're considered a group audit because you do have a component unit, which is the educational foundation, which is included in your financial statements. Management did not consult with other accountants under the application of any generally accepted accounting principles or GASBs that were issued. Our audit approach, we use a risk-based approach. The areas we tend to need to focus on by standards, we have to look at revenue recognition and timing. For you all, we also look at payables, accruals, other liabilities. Payroll expenditures obviously is your largest dollar item on your financial statement, so we spend a good amount of time looking at that. We review the actuarial reports and make sure that we agree with the assumptions that the actuaries are coming up with. We also focus on non-payroll expenditures. We use our IT specialists that we have within the firm located in our office to review any of the IT systems that we rely on. We also look at grant compliance and then the financial statement disclosures. Moving forward, thinking for the future, there's 2 financial statement changes coming down the road for you all. One is going to be Statement 84, which is related to fiduciary activities. Right now, the school funds are essentially reported as a fiduciary fund in the financial statements. There's a new GASB that's been issued, and the initial evaluations are that those may move into funds of the general fund. Moving forward. So we are actually hosting, and I'm sure Rob will be attending, we are hosting a GASB 84 workshop with Maryland school districts coming up. I believe it's in February, January, February, which we'll be meeting to go over the implementation of this GASB, how the school systems are all going to handle it, and then whether MSD needs to make any changes to policy of the categories and how that will be impacted. So that will be a change that we will discuss next year's December meeting when we have implemented it.
I'll just jump in too. So we're on top of this, and like Bill said, we're going to all the different meetings regarding this. One ramification, by putting it as a governmental fund or special revenue fund, it will mean more schedules. So right now we just have one schedule for the student activity fund, but we'd have to do a income statement as well as a cash flow statement as well. So,
yeah. And it will impact essentially our audit procedures too, because as it moves into a fund, it's going to get more attention, because right now it's lumped in with pension, OPEB, trust as an aggregate remaining fund, so our materiality is much higher. As it becomes its own fund, we will be opining on that fund individually, so we don't currently do that. So under the new standards, we will have to, so it will have an impact on the audit strategy we go with moving forward, and we'll have to do additional procedures related to that. Then there's GASB 87, which refers to leases. That one's a little bit further down the road. However, that is where you must evaluate all your current operating leases, and then you'll need to book those onto your financial statements as an asset and a related liability. Currently, you only do that for capital leases, so any operating leases, you just make a monthly or an annual payment. You don't have to record the full liability on your books, but you will be picking that up, but you also pick up an asset that will be there too. So that one probably will be less impact. Well, I can tell you it will be less impactful than GASB 84 to the school system, because you don't have too many leases that you would have outside that we'd have to look at. That's more higher level for state agencies and some other counties. So it will have some impact, but minor compared to what 84 is going to bring you. With that, I can answer any questions.
So did I hear you correctly about the student fund moving somewhere else? What, can you elaborate on that?
Yes, excuse me, GASB 84 essentially says it changes the fiduciary funds to where you have to evaluate, and then when you go through them with school funds, basically if the school system has any control over those funds, and the control is defined in there as if you have an advisor that's approving the expenditures and active.
Can you go back a step? And school funds specifically, what are you referring to?
School funds, we're
Are
referring
the
to the-
IAF?
Yes,
Or-
yes, he's referring to the
Okay.
IAF.
All right, yeah. 'Cause
Yeah.
this is an important piece.
Yes.
I think principals would be interested in this.
Yes. So there is some money that you all do give to the school, the IAF funds that are just
Right.
general spending for the principals. Those are easily determined that, yes, those will be rolling forward. Then there's also the school groups, right? So if
Right.
you have the school groups that are raising money for different functions through fundraisers and things like that, because of the way most of the things are structured within not just MCPS, but most school districts in Maryland, you have a faculty advisor, you do have oversight, they're required to keep a bank account using your EIN number. A lot of those things, when you start going through the GASB, you end up checking the boxes that, yes, essentially they are, you do have involvement in management of those funds, and under this GASB 84, those actually will roll from, well, fiduciary just means basically you have a fiduciary responsibility, but they're not really under your full control, where these would now be considered under your control and would move, as Rob said, either into part of the general fund or into a separate special revenue fund or other kind of governmental fund on the financial statement. So
What general fund would that be?
it would be the main general fund.
For MCPS? Or?
Yes, and it would be for financial reporting purposes only. You can still manage them the same way that you're currently managing them, but for financial reporting, they would either fall into that general fund or into, we could have a separate, possibly special revenue fund that they could fall into.
So like Bill mentioned, currently, as you know, we have a separate financial system for our IAF. So that wouldn't necessarily have to change. It would just be at the end of the year, we'd have to bring that data, which would include revenue and expense data, into our CAFR.
Yes.
This is all about including it in this final report. It is not about the management of it. No, it still is an important new requirement, because that means it will be under the possibility of parts of our audit, not just our reporting. So our auditors will be, although there is some piece that we're looking at now, there'll be a deeper look into some of the areas, because this will now be reported as part of this report.
Right, and when will that be effective?
FY20.
Okay, so we're going to share that information with principals, I would imagine. That what's
So
gonna happen.
we will share the implications of this with
Okay.
principals.
Right.
Certainly, hopefully they're managing their funds
Right, right.
as you expect them to, because they're already being audited internally, as you'll hear in one of your later reports. It should not impact how they manage the funds, as long as they're managing the funds as expected. It will impact the work that Rob and his team and our external auditor will have to do in terms of what they'll be required to report.
Yeah, but I think it would be useful for them to know that there's this additional step as well. Yeah, so, great, okay. Yeah.
So I guess the implication here, it changes the materiality in a lot of your testing then, right?
Yes, yes.
So it brings it to a much lower, so much more is on the board for testing, so it creates a much lower level of audit review to make sure the principals are doing what they're supposed to be doing.
And we, as Nikki mentioned, we do some of that now. We also do rely on the work of internal audit, looking at what they do. But as you mentioned, you're very well aware that, yes, our materiality level is bucketed in with OPEB pension called the aggregate remaining. So it's going to go significantly down there. So we'll have to do special. And again, they have some different controls that are separate from general disbursement processing. So we'll have to go and test those controls a little bit differently. You know.
Great. Ladies, anything? No? Okay, thank you very much.
Thank you.
We
So I just want to
appreciate it.
thank Rob as he's
Right.
leaving, for the incredible work of his team, and certainly Bill and your team for working so closely with us. We have a lot of partners that work with us on all the
Right.
reports here.
All righty. Okay, we are now at 6.1, the MCPS self-insurance program. Yes.
So, sorry. Guess it's a lot of my show today, right?
Yeah.
So workman's comp and self-insurance, we've had some related questions, some just questions that were general questions that you asked at your last fiscal management meeting, and then there was some follow-up to the OLO report. And what we wanted to do is give you a quick rundown of answers to all of your questions, both those related to the OLO report and those questions that weren't related to the OLO report. Let us give you just a little context first, because a lot of people don't know what our workman's comp and self-insurance fund is all about. It's a government insurance program. The law provides that employees who are using and have a claim of a work-related injury will receive 66 2/3% of their average biweekly pay. MCPS employees can use an in-network physician for medical care, and if they do that, they will receive 100% of their pay. That's a critical aspect to receiving 100% of their pay. We communicate that with them, and we'll get back to that information at a later part of our presentation this morning. So MCPS workers' comp is actually administered by Corvell. We do this with the Montgomery County as being part of the Montgomery County Self-Insurance Fund for workers' comp. And the budget for it from the MCPS budget, and this was a question you asked at one of your previous meetings, is almost $23 million. It's $22.998 million, and that covers the cost of that fund. So one of the follow-ups from our previous meeting was that the OLO report provided some recommendations, and you asked us to provide you with some follow-up on these recommendations. I'm going to turn it over to Mr. Talor. He is going to share with you just briefly where we are in terms of responding to those recommendations and any next steps we might have.
Good morning. I'm Krishna Talur, Director, Employee Retiree Service Center. As a follow-up to the Inspector General report, Dr. Smith sent a letter to the board on September 5th outlining the 6 recommendations that were in the report. The first one was to continue to develop a central incident information collection and clearinghouse and expand the current MCPS Incident Review Committee to a system-wide program. This is something that several departments in MCPS are going to work together to come up with a incident review committee. One of the goals that we have here is to explore and see the online information that is available and provided by Corvell Corporation, that's the third-party service provider, and see how we can leverage that system to further improve our processes.
I just want to add to this. We've actually had a couple of internal meetings already because a lot of this work is contained within the operations divisions of the school system. So if you'll recall, the report spoke to the Division of Maintenance, which was really what they shone a spotlight on. They said, this is really best practice here. What maintenance is doing, maintenance is coming together across depots, looking at incidents. We think that you should scale this across departments. So we have pulled together transportation, we've pulled together construction, we've pulled together maintenance, we've pulled together security to start where those are our higher incidents of workers' comp claims and plant operations based on the nature of the job. What I would say, just so you know, what was interesting and not mentioned in the report was that when maintenance started this process, it had nothing to do with workers' comp. It had to do with what we would want our maintenance division to do, which was to improve workplace safety. Out of that, we are seeing some possible efficiencies in workers' comp. So there's just a broader picture here, which is about workplace safety, which we want to put on the table. And from that, we will then go to workers' comp. And that was a bit of a learning just for everyone involved, whereas the OLO report focused on workers' comp, it did not make mention of the genesis behind the Incident Review Committee. So one of the reasons this is taking us a little bit longer than just a workers' comp approach is we're starting at the workplace safety and then we want to tie it into workers' comp, not the other way around. So we will loop you guys in. We are a couple of meetings away from doing that.
Sure.
Absolutely. And I set us on the wrong path. I used the term OLO for the report, and I was reminded as Mr. Talor was speaking, it's the Inspector General, and so I apologize because I also got Dr. Zuckerman saying OLO report. It is an Inspector General report.
Thank you.
The second recommendation was to establish metrics for incident reduction and consider them as an employee performance measure. and as Dr. Zuckerman just alluded to, is looking at this as a workplace safety issue and then resulting in the workman's comp. What this entails basically is that we have not had a practice where if an individual is injured at work, to review that as a performance issue in case appropriate safety protocols were not followed. Employees get various trainings, whether it be slip, trip, fall, or other related issues. So if an equipment is being used in a not an appropriate manner, and that resulted in an accident, it's not seen as a performance issue. Looking at it as a performance issue requires bringing our association partners together, employee engagement, and discipline, all of those areas together, and that is another area where it requires operations and OEELR's engagement. Doing this does not preclude anybody from being eligible for treatment or compensation benefits. That's a completely separate aspect of it. So one of the issues is to make sure individuals understand that any injury is covered and it's treated, but at the same time, we also look at it as, is it a training issue or is it a performance issue? Is it a repeat issue and things of that nature? So that is another thing that's also on the table for a cross-department work.
This is a great example of us appreciating the input of the Inspector General, but also recognizing that the policies and practices in Montgomery County may not always exactly align with other parts of the county organization. So the notion here around looking at this as an employee performance measure has not been our practice. And so we've taken this recommendation and are looking at it in a little different light in terms of making sure that we're following all the safety procedures, but rather than looking at it as documenting employee performance.
And I can see down the road maybe an internal audit perspective on some of this stuff too, to make sure policies are in place and they are being followed. So something that MJ and folks could probably look at when it's established.
The third recommendation is to continue to improve and train staff on reporting and documenting events and information accurately. This is one of the areas where a lot of work is taking place and continues to take place. The Leave Administration Department and the Workers' Comp unit in particular is one of the highly sought after teams within our department. Various departments, transportation, maintenance, schools, they ask our staff to come to their locations, to their orientations, in-service days, to make presentations on how to appropriately document and report these incidents. Recently, Corwell Corporation upgraded their website in how to report these incidents, and we have received a lot of favorable reviews of that. It was not truly related or result of the report, but it was something that the administrator was working on as part of their own process improvement, but it happened to come along and line up at the exact time. So on October 28th, we had a timekeeper meeting, which is who are the first point of contact administrative secretaries at the school who get the incident reports first and they report it. So we had that meeting, we had about 300 to 350 participants. We run those meetings twice a year, 2 sessions a day, and a Corwell Corporation representative came over to the meeting and they made a presentation of their new online website and how to report the incidents. There is a link that's been made available to all schools, and recently the same demonstration was done at the financial specialist meeting, and we received kudos from participants thanking us for the work that we did. So this is something that's ongoing, and we will continue to do that as has been recommended by this report. Number 4, this is a 2-part recommendation. One is to eliminate the redundant MCPS documents. Specifically, they brought up 2 sets of forms. One form is called Form C30. Another one is called the 440-35 and 40 to improve the efficiencies and reduce the burden on employees. This is one recommendation where we took a step back to say this is probably not something that is feasible to implement or adopt in the manner it's been recommended, because these are two different forms, two different sets of forms. The Form C30 is a state of Maryland form where an individual is required to submit the form to the state directly, describing what happened. There are two aspects when the injury takes place. The workplace reports the injury to Corewell for the purpose of adjudication and benefit payment. That is the version that has been communicated by an individual to their worksite location, and the worksite location reports that. However, the Form C30 is the injured individual's own words describing what happened, which has to be recorded with the state. So it is not possible for us to letting staff know, no, we are going to eliminate the form to reduce the paperwork burden because it's mandated by law. However, the other two forms, which are MCPS forms, one is to apply for leave or extension of leave, and the second form that comes with this, and there are too many numbers here, the one that says 440-40 is a physician's note letting MCPS know the individual is injured and the duration for which they have to be out. We have noticed that some individuals, some employees fill all the forms every time if they have to extend their leave, and some of those forms are not necessary. So what we can do, and we believe we will continue to do, is having a better communication with the impacted employees, letting them know what are the only forms they need to fill rather than filling 3 or 4 forms all at a time. So that, I believe, is something that we are going to continue to do as an internal process practice, but eliminating one of the forms at this point is not feasible. However, we can by better communication, reduce the feel of burden of paperwork. The second part of the recommendation was to clarify the collective bargaining agreement language to emphasize the required use of preferred provider for all service providers to access enhanced workers' comp benefits. This is basically talking about employees being eligible for 100% of their pay if they are in-network, or they go to an in-network service provider of the network that's established by Corewell. One of the contract, the employee contracts do have specific language, and I'm going to quickly read one of those. It says a unit member who is physically unable to report for duty as a result of an injury in the line of duty may be placed on workers' compensation leave at full salary by the superintendent or designee, provided the unit member seeks medical treatment with respect to the injury from a physician who is among a comprehensive list of preferred providers approved by the board, which being Corewell, who is part of the approved administrator of the plan. Employees receive the same information in multiple ways. When Employee Retiree Service Center gets the notification of a claim, we send an email and a letter that provides the list of service providers, and it contains all the names that individuals can seek. In addition, the adjudicator from the Corewell Corporation who calls the employee to find out what happened and get the details in adjudicating the claim also communicates the same information to individuals and provides the documentation. So we believe that there are multiple communication methods that are in place that communicates to employees that they are eligible for 100% of pay by using in-network providers. We will continue to look for avenues to communicate this message, especially at the incident reporting time at the schools, to make sure they communicate the message to their staff. Many times when employees are injured, their first and our first interest is they seek the medical attention they need right away, and so these things follow, and some of those procedures are in place.
We have copies of the list of in-network providers?
Excuse me, I'm sorry?
Yeah, so we send it to them at the time, but as part of the letter, but we can certainly get you that list if you would like.
Can we get the copy?
Absolutely. And we'll get you the copy of the letter along with the list. So I think the question here, the contract certainly reads that you get 100% coverage if you use an in-network provider. Once we are aware and once Corvell is aware of a claim, that information is shared with the employee in both an email and a letter along with the list of in-network providers. As Mr. Tiller mentioned, we will look for other ways to communicate that. But in reading and looking at the communication that's there, it is pretty straightforward. We will look to see what other mechanisms we can use if there's confusion about the fact that if you don't use an in-network provider, you are only provided 66 2/3 of your salary.
Number 5, explore and evaluate other providers of workers' compensation coverage to develop metrics to evaluate value provided by self-insurance fund and their third-party administrator. So this is a huge recommendation in terms of evaluating how MCPS works and conducts this business and ensuring that we are legally compliant. There are a couple of ways of looking at it. One of them is to explore the option of bringing the workman's compensation claim payment process in-house, which requires an approval to conduct a study because we have not done that. And we need to know what is involved in implementing this kind of a program in-house, the expertise needed. Being part of this county self-insurance fund, we get the legal support that's needed from the fund. There are medical professionals available to us through the fund for questions or clarifications, and those are the type of skills that we will have to have in-house, and to evaluate whether we have individuals on our staff to implement such a program. So those are the things that need to be evaluated. The second part, or the second thing that can be considered is working with other organizations, group insurance concept. One of the organizations we talked to is MABE, but they do not like to work with huge school districts on insurance or liability issues like this, so that's not an option. So that is the one that's exploring. So we have to explore other providers. However, since this is a decision that not just impacts us but also the county, this is something that has to be taken in consideration of what it means. I am not sure at this point if the corresponding report on the county's program has also been published, because there were 2 studies that were taking place. So this will require some more time for us to evaluate what it means and if it is feasible for us to move forward.
Yeah, I think MABE also gets a fee for making that connection with the counties and this insurance provider.
So the last consideration was to create a light-duty program. MCPS has, in the past, examined the feasibility of implementing a light-duty program. That doesn't mean we shouldn't consider it again. There certainly are a lot of complexities associated with the light-duty program. So just in brief, a light-duty program means that someone was injured, they cannot return to their job, and so they're brought back, they continue to get their full salary, and they do another task. And so one aspect of that is having whatever that light duty might be. It lends well to types of jobs that have and agencies or departments that have both kind of a light duty component and a not so light duty component that the employee might be in. So nothing actually comes to mind as I'm thinking about it other than being a police officer, and not that I know that much about being a police officer. But if you think about light duty for a police officer, it might be the component of their work where they are doing desk duty, and there's a role that they're still doing that aspect of the work versus maybe an injury is keeping them from being out on, and I can only think of the word, on the beat. So that's not that's the right way to describe it. So most of our positions in this organization don't have that dual kind of role. And so what we'd have to do for, say, let's say a maintenance worker or a building service worker, someone who had a position that was very physical and that was what they were unable to do, is to identify what they could do that would be light duty. And at the same time, we would be paying a substitute or somebody to come in and do their position. So it doesn't, it's not a cost-saving measure, but rather a measure to have someone return to work. Identifying those sorts of roles, and also identifying those sorts of roles in a way that it doesn't become a disincentive for someone to return to their role is something that we certainly would need to examine. And so we're looking at some possibilities, and certainly we'll continue to explore if there are ways to do light duty for some positions, but part of that really involves being able to identify what that duty would be and do it in a way that doesn't de-incentivize someone from coming back to work. I did have a conversation with Mr. Riley, who was here earlier. In Frederick County, they had done some work in this area, and they were bringing in people from maintenance and other organizations to work in his budget office, and he said it became a struggle because they didn't have work, and so the notion that you put someone in an office and that not be in their skill set did not necessarily work. And so you really have to be very thoughtful in the way you develop a light duty program so that the type of work assigned that is light duty actually lends to what the person comes with in terms of their skills and knowledge. So we'll continue to explore that and look at how it might work and what other things we can do to incentivize people when they're ready, certainly, and when they're well and able to come back to work. And that's something that will be worth some study. And I know Mr. Tallur is working with some of our departments to see if they have some options to consider maybe on a pilot basis. And so our next steps, we have some work groups that we just talked to you about bringing forward in terms of employees and how long they're on workman's comp and how we can bring them back for light duty. We want to be able to present our findings to you in terms of each of these next steps at a future meeting, and so our plan is to be able to do that hopefully by the end of this fiscal year, if that makes sense in terms of our overall schedule.
Okay. Questions? No. Okay. All right. Thank you very much.
Thank you.
Okay. On to now the budget, 7.1. It's the Nikki Diamond Show today.
So I just have a very brief update for you. You have a budget presentation from the superintendent, so I just wanted to just give you an update in terms of where we were with the process. Next week, the superintendent will be sharing his budget with you and with the community, and we have a nice schedule for the upcoming weeks to get feedback and input. A reminder that the budget, a lot of people think of it as that budget document, but the budget is a live and agile process. The document is just a moment in time, and it changes constantly. We're monitoring the budget, but we're also adjusting the budget. The budget's what we do in terms of developing a plan and putting numbers behind that plan, and then we make those adjustments throughout the process as the superintendent presents and gets input, and you as a board presents and get input, and then we look at our funding sources. So between now and the middle of June, the beginning of June, that budget will change quite a bit. We wanted to just share with you, not that you can see all these numbers, but our budget is something we've been studying and looking at with you as we look at our plan and how we fund our schools across each of the different areas. We spent a considerable amount of time with our budget review committee, budget advisory committee, and getting feedback and input from stakeholders. I know Mr. Morella was able to join us, and it was great having a board staff member with us talking and giving us some thoughts and being able to see the workings in place. We spent time in that review committee meeting and hearing input from the community, and we organized it through a variety of lenses based on feedback from them. We looked at it through system priorities. We looked at it through the chapters and the organization of the overall document, because a lot of people think of the budget in terms of that document, and that's what they know. And we also looked at it in terms of the type of spending. And so at each of our meetings, we spent time together talking about what's there in the budget, how those dollars are spent, how they meet system needs. needs, but also hearing about the experiences of our community members. Our senior leadership joined our budget advisory this year for the first time, and so we had everybody in the room together talking about and sharing both what was working, what wasn't working, and where we needed to move in terms of the organization. So through each of the themes of our meetings, we talked and we shared input together. We talked about those sorts of things that were in focus, that we felt from our personal experiences for the stakeholders and from those of us that manage parts of the budget, what we were doing right and what was making a difference for students, where we had results, and we talked about a lot about results. We talked about those things that were out of focus, that we weren't doing in the way that we needed to, that's not having an impact, that we maybe needed to examine in different ways. We talked about things that we needed to adjust our focus on. So what are those sorts of things that we're doing, but maybe not in the way we need to be, maybe not to the extent we need to be, not really hitting the mark, we needed to adjust and do differently. And then we talked about things that we needed to do, to start doing. Either we were doing them on a small scale and they needed to be extended, or that we needed to start doing and we weren't doing. That stakeholder input is what the superintendent used to create and develop the first shot at the budget that you'll be hearing from next week. And as you know, that budget for Dr. Daka comes with two parts. We have our expenses, those expenditures that we believe we need to make for our students, and we have the revenue, and they need to match. And so we have to look at and measure where we think we are in terms of state revenue. We have to look at our fund balance and what's going to be available. We have to look at what's required by maintenance of effort, as well as what we also think and need from our county government in terms of funding. And then the expenses that those revenue points bring us to. Those expenses, we look through different lenses. We look at what we need in terms of salaries that represent 90% of our budget. Our benefits, you heard a lot about our benefits and insurance today. We have to examine rate changes and inflation and those things that impact existing expenses. And we also, of course, have to really dig into our priority work where our students need it most and the work that we're committed to. And so the superintendent will be sharing that budget with you on December 18th, and we have a variety of different things that will be happening between that date and when you as a Board of Education will be looking at the budget on February 10th. We have 2 hearings as well as 2 work sessions where there'll be time to hear from the public, to get input from them and different stakeholders, as well as to hear from staff and to work with you and answer questions for you. And then we go on to hear from the county council and the county executive, and we bring, which brings us to June 11th, where the board will finally adopt the final budget. So I just wanted to provide an update to you in terms of the process. It's been moving along slowly and cautiously, but thoughtfully as well, and we will be ready to bring you the budget, and the superintendent will be sharing that next week.
Okay. Do you have questions, ladies?
Just, I think all of us received an invitation from MCCPTA that January 4th, they're having an operating budget training for people in advance of testimony. Have you been invited, or?
I believe the superintendent has been invited. He, I think, is not available at that time. And so we are going to work, Mr. Morello and I will work to identify who can be there to support them in their budget work session. Last year, I actually went and helped them understand what was in the budget and answer questions so that they can do some preparation. And I believe, Mr. Morello, you said you were going to be able to attend, and we will work on making sure that they have the support they need at that meeting.
Because I know, I think it's important, and back in the day when I was a cluster coordinator, they used to routinely do the training, and it's important, especially so that people understand the difference between the capital budget and the operating budget, because sometimes it gets mixed up. And then just the only other comment about the importance of having all our ducks in a row. Last year, Howard County had a $40 million shortfall in health insurance, and so that was a real challenge on going forward on their operating budget. That's a significant hit. So.
Absolutely, and that's why, the reports you heard this whole morning, and the work that we do on a regular basis with you as a board to monitor all different aspects of our budget, to work with our actuaries, our auditors, to make sure processes are in place to both protect the dollars, make sure they're being spent in the way that they were intended, but also see where we are in terms of our financial status, where we are in terms of everything from our healthcare fund to our pension fund to each of the accounts and the categories. Certainly, we had a very clean audit, but that is something you have to keep doing work on. You don't just rest on your laurels and move forward. We will continue all those processes. And there's a great team with everyone you met today, from Ms. Grant and Ms. Lau to Mr. Riley, who does that work. And so we've been working very closely with Mr. Morella to make sure that we're working with his internal audit team and keeping all of our processes in place.
Right. Okay, so I would like to just announce the dates for the, operating budget public hearings. That is where, the public can come and share comments with us. So those will be January 13th and January 15th. And then the Board of Education will have operating budget work sessions on January 22nd and on the 28th as well. Okay? All right. So it is past noon. I do have another commitment outside of the building at 1. I know we still have 8.1, the internal auditor fiscal year 2020 work plan. How long did we think that would take?
It probably would take 10 minutes, but I can do it in 30 seconds if you want.
No.
I mean, we have a slide deck together that MJ was going to present, but I can,
Okay.
or I can quickly discuss what the changes are
Okay.
that I'm implementing.
Okay, let's move. I was going to, suggest that maybe we put it in January, but
That's
if
either-
it's
either
just
way.
10 minutes, then, okay.
Thank you.
Because I do want to be respectful of our time as well.
Yep.
Okay, all right.
So I'll kick this off very, very quickly.
8.1, the
thank you.
internal auditor fiscal year 2020 work plan. Thank you, Nikki, for the update.
So I'll kick this off very, very quickly. When I came on board here a couple of months ago, there was a couple of things I noticed that I thought maybe we could do a little bit differently. I'm proposing that we implement some changes, and we've actually implemented some of these changes already. I took a look at the internal audit unit's agenda for this year, and it's remarkably similar to what it's been for the last 3 or 4 years, looking at it. So I'm really trying to take a more risk-based approach to what we audit versus what we've always done. It includes some of the factors in there as more of a targeted oversight, where the internal controls are at the highest risk, where there's experience levels with principals. If we've been, and we talked about this very recently, we've been to a school, Woodfield, for the last 2 or 3 audits, completely clean. I don't know why we need to go back to Woodfield anytime soon, where there's schools right now that we have repeat findings year after year after year. And we want to go back and work with those schools and help them with those findings. And most importantly, put corrective action plans in place that they are accountable for achieving. We do corrective action plans now, and from what I see, while I think they put a lot of thought into them, I don't see a lot of follow-up throughout the process. We don't go back and say, show us the evidence that you are actually making these changes. And I think that that's really critically important for MJ and folks to go back and make sure these changes are taking place so that when we do that follow-up audit, things are better. It's not about the audit and the finding, it's about the result of the audit and the finding. I've been in places previously where people counted the number of findings, and I always thought that was ridiculous. It's what's the impact of what you're looking at and how are you improving operations for that program, school, or whatever. So that's really what I think I'm looking to do in the very, very near future. Also, I noticed that we're a lot later than I'm comfortable with in giving you guys an audit agenda for the year. It's December, we're 5 months into the year. If you guys wanted to, if the board wanted to come in and make changes to that agenda, it's too late. And I don't want us to be caught in that position next year. So I'm proposing that we bring it in much earlier into the summer so that you can add your flavor to the agenda if there's something you want to see individually looked at over the reporting period. So given that, MJ can go through her slides very, very quickly if she wants to.
you have the plan in front of you. The last time I presented, you did ask about the repeat findings, and I did have some slides on that. I don't know if you want to see them or.
Well, I think what Dan was saying about, the corrective action going back would cover that.
Yeah,
I think it's a good thing because that's been an issue for a while. Yeah.
So what I'm doing as the acting supervisor is I'm really looking at when the action plan comes in, and did they address what the audit findings were? Because what we find sometimes is the action plan really isn't addressing what the finding was. So when we come back a year or two later, they didn't address it because they didn't understand it. So I'm really making sure that the action plan addresses it, and then, like Mr. Morella says, we're looking at those schools that maybe we need to go back. You've had an awful lot of findings. They've been repeats for the last 2 audits. Let's come out and see what we can do to help you.
Right.
To make sure you understand what the issues are. So that's the idea, the plan, where we're headed, and hopefully that'll be successful.
And the last 2 points, and I think that we've covered everything, is we need to work really closely with OSSI so that as they work with their schools, they're putting a lot of emphasis on these corrective action plans.
Right.
Because ultimately, they have the same interest we have, is to correct those problems. And what MJ just said, and as a final point here, a couple of weeks ago, we went back to a school where there's been repeat findings. It was, doesn't matter the school, but we would repeat findings. And MJ and I actually went back there, and MJ spent the morning doing corrective actions for them and teaching them and training them so that we expect it not to happen again. What they probably don't know is we're going to go back much sooner than their next scheduled audit and just come in one day and say, are you guys following those processes? Show us. So we want to make sure that we're here to help. We're not here to put fear in people, but we want to make sure these recommendations are taken seriously.
Right.
So.
Well, once again, I think that's, long overdue as well. And I think, the piece with working closely with OSSI is important because in the final result, the directors, they are the ones who supervise the principals in the school. And, what goes on with the fiduciary responsibilities is ultimately their goal as well. But I appreciate the emphasis on this.
We've got no pushback so far, so it's been good.
Great. Good.
Thank you.
Okay.
Sounds like a good plan.
Thank you, guys.
Did you have other questions from? No? Okay. All right. So thank you very much, MJ and Dan. And moving forward, our next meeting, unless there's some new business or final comments or questions, will be on January 21st at 2020. Wow, that's coming up soon, at 10 a.m. Okay, all right. We in agreement that we should adjourn?
Yep.
Yes.
Okay. We are adjourned. Thank you.